Charlie Munger once said that the first step to building long-term financial freedom is to accumulate $100,000. Moreover, his business partner at Berkshire Hathaway, Warren Buffett, emphasized the importance of building a passive income snowball. Reaching a $100,000 milestone in savings is significant because it represents several years' worth of living expenses and marks a point where the growth of the investment portfolio starts to be driven significantly by earnings and compounding rather than just additional capital contributions. This shift allows for faster wealth accumulation without needing to proportionally increase personal savings. It also indicates that the investor has likely been saving consistently, which is crucial for an investor's long-term success, especially in volatile markets where emotional reactions can lead to poor investment decision-making. Turning $100,000 into a passive income stream requires a strategic approach involving wise asset allocation, diversification, and continuous reinvestment to harness the power of compounding. As the portfolio grows, maintaining appropriate diversification mitigates risks and ensures long-term growth. Consistent investing, even in small amounts, coupled with proper risk management, leads to significant wealth accumulation over time. At this milestone, the focus can then shift from aggressively adding capital to managing and growing the existing capital base, with the passive income generated providing substantial financial freedom and flexibility. In this video, we will look at several reasons why the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD, stands out as an effective vehicle for building a dividend snowball that can power you from $100,000 to financial freedom. Hey everyone, this is Samuel Smith. I run High Yield Investor, the top-ranked investment group on Seeking Alpha, and I specialize in dividend investing. Before I get into discussing the SCHD ETF, I wanted to ask you to please give this video a like and subscribe to my channel. I just started on YouTube to share my unique approach to dividend investing with a larger audience, and I need your help to make it a success. Thank you very much. The first reason why I believe that SCHD makes for a good passive income snowball is because it has generated very strong dividend growth. Over the past 5 years, it has a dividend compound annual growth rate of 11.8% and a 10-year dividend CAGR of 10.87%. Moreover, it has consistently increased its dividend payout annually with a 12-year dividend growth streak. The second reason why I think SCHD makes for a good passive income snowball is that it has an attractive starting yield. The importance of having a sufficiently strong starting dividend yield is illustrated in the chart below. You can note that this chart does not even include reinvesting dividends, which makes the differential in required dividend CAGRs between the starting dividend yields even starker. It should be obvious that the lower initial dividend yields necessitate much faster growth rates, while the higher initial dividend yields can achieve the same future yield on cost with much more modest growth rates. However, what is most intriguing to me is that the relationship between the starting yields and the required dividend growth rate is exponential. Given that SCHD has a starting yield of about 3.5%, it sits in a much better position than many other popular ETFs today. For example, the S&P 500 has a starting yield of only half of SCHD's, and the Invesco QQQ Trust ETF, or otherwise known as the NASDAQ, has a starting yield of just 1/7 SCHD's. And even the Vanguard Dividend Appreciation Index Fund ETF, ticker symbol VIG, has a similar starting yield to the S&P 500, so only about half of SCHD's. When you combine this with the fact that SCHD's very strong dividend growth rate also sets it up for long-term dividend growth, the path to achieving a very high yield on cost in a reasonable amount of time is quite clear. The third reason why I like SCHD as a passive income snowball vehicle is it has low long-term risk. In addition to its powerful combination of current yield and dividend growth, SCHD rounds out its credentials as a powerful passive income investment vehicle with its relatively low risk cost structure. First and foremost, its expense ratio is roughly only 0.06%, which makes it an investment vehicle that Warren Buffett would probably approve of, given his past statement, "Performance comes, performance goes, but fees never falter." This means that investors will lose relatively little of their investment profits over the long term, reducing the risk of underperformance and/or lackluster dividend growth over time. Additionally, SCHD has low risk because it holds 103 individual stocks in its portfolio that are well diversified across numerous major sectors of the economy. As a result, it should be able to sustain pretty solid dividend growth through various ebbs and flows, technological disruption, and macroeconomic conditions, as various portions of its portfolio should be able to sustain at least decent performance in a wide range of economic scenarios. Moreover, it is well insulated against individual company risk, given that it is well diversified across so many companies. For those looking to adopt Munger's and Buffett's method for achieving financial freedom, with an emphasis on substantial growing and reliable passive income, SCHD is a pretty good option. That being said, SCHD's primary weaknesses include a relatively low dividend yield for those seeking to live off of passive income, since it's below the 4% threshold of the typical 4% rule, and it also has limited exposure to key income-producing sectors like infrastructure, utilities, basic materials, mining, real estate, and communications. Additionally, its passive approach to investing means that it fails to take advantage of capital recycling, which is an investing strategy that I will discuss in my next video and can be particularly effective at accelerating the compounding process when investing in high-yield stocks. For these reasons, I do not personally invest in SCHD, but instead build my own portfolio of high-yield stocks. This approach has worked well for me as it gives me a dividend yield that is roughly twice what is generated by SCHD and has generated nearly double the total returns that SCHD has generated over the past 5 years. If you found this video helpful and would like to hear more in detail in my next few videos on how I manage my high-yield portfolio to beat the market, please like and subscribe to my channel. I'll be sharing more insights on dividend investing and how to build a better passive income portfolio in the coming days and weeks. Thank you for watching and see you next time.